Verizon have just reported their earnings. They are up around 6% on the day, and now is the perfect time to sell. In today's episode, we're going to take a look at Verizon. We're going to take a look at the past performance. We're going to take a look at their income statement, top line revenue growth, as well as their bottom line net income. We'll have an updated look at the health of the company's balance sheet, their total cash versus their total debt. We'll also see how well they've performed over the last 5 years against some of their well-known competitors. We'll also peek and see what institutions have done over the last year as well as the latest quarter, whether they've been buying or selling. And we'll discuss some of the insider selling that the vice president has done not too long ago. And as always, we will run through the dividend safety, look at some of their important financial metrics, and touch upon their latest earnings from this morning. And finally, we will put them through the valuation model to get to the intrinsic value as well as the acceptable buy price, given that investor margin of safety, as well as seeing what Wall Street are forecasting for Verizon over the next 12 months. So let's jump straight into the earnings report. Now we can see they have reported a loss of $2.7 billion in their fourth quarter. Now, in terms of unadjusted, it is 64 cents negative, but earnings adjusted for the asset impairment cost as well as severance costs are $1.08 per share, which in fact did beat Wall Street estimates of $1.07. When we take a look at their revenue, we can see they did post, in fact, a beat on the top line, $35.13 billion versus analyst estimates of $34.82 billion. So in actual fact, they did have a double beat on the earnings per share as well as the revenue. And we can see their revenue for the year has been reported at $134 billion, with a total reported and recorded profit of just under $12 billion, with the full year earnings between $450 to $470 expected. So let's take a look at how that all adds up and why we are looking to sell Verizon. Now, over the last year, we can see they are up around 5.5%, which is pretty much all attributed to today's bump. So otherwise, they would have been flat over the last year. Over the last 10 years, we can see in actual fact they are down around 13%, quite some way away from their all-time highs towards the back end of 2020 of $62, and they're nearing towards that 52-week high. The current yield is just under 7% with a forward PE of 8.5. Now, in terms of their revenues year on year, we can see December 2018, $131 billion. As always, we look for 3 to 7% growth year on year. December 22, $137 billion reported, and per the earnings report today, they are expecting the full year 2023 $137. So in terms of movement, we can see, yes, it has increased from 2018 to 2023. Although when we look on a more granular level, we do see an increase to 2019 before dropping in 2020 and then picking back up, with 2023's top line expected a small increase from the previous year. Now, we will take a look at the last 10 years percentage-wise, but we can see a lot of inconsistencies over the last 5 years. And in actual fact, when you consider inflation, in real terms, it isn't really increasing the top line. Bottom line, what story can we see? $15.5 billion in 2018, 2022, $21 billion, and we can see the bottom line, as we did discuss earlier, around that $20 billion mark. So again, yes, they are increasing their bottom line, which is positive, but the inconsistencies still show on the bottom line, decrease to 2019, before another increase to 2021 and then picking back up in the wrong direction. So we can see just a lot of inconsistencies both on the top line and bottom line. It isn't really moving consistently and in the right direction that maybe you'd like to see. Quick health check of the company, total cash versus total debt. $2.7 billion of cash in 2018, $4.3 billion in their latest report. So they are holding more cash than they did 5 years ago. Now, when we take a look at their total debt numerically and directionally, we do in actual fact see that total debt has gone from $114 billion to $178 billion. Now, this is a bit of a worry. Their total debt has increased significantly over the last 5 years. So it is something just to keep in mind and something that we will take a look at when we analyze the net debt to EBITDA metric. Now, taking a look at the performance over the last 5 years, and specifically just last year on a total return basis, so including those dividends reinvested, Verizon is up around 13.5%. Bear in mind that is if you were to purchase these shares towards the 52-week lows. When we take a look at the last 5 years, we can see Verizon down 5%, the worst performing in the sector against some other well-known competitors. You can see AT&T here up 2%. Now, to be fair, just because it is the worst performing over the last 5 years, do bear in mind it doesn't necessarily mean that past performance is an indicator of future, but always something just to consider. Institutional ownership, well, it sits at 61%. We can see around 11.5 billion worth of sales over the last 12 months. And over the last same period, in fact 12 months, we see nearly twice as much buying by these institutions, more inflows than outflows. And when we take a look over the last year, we in actual fact see a lot of inconsistencies. In Q1, there was more selling than buying. Q2, the opposite, and again Q3, the opposite. And in Q4, again, still more selling than buying. So in recent periods, institutions are selling their shares of Verizon. But as I always say, and always want to keep it consistent, we should never take a look at what institutions do and copy it, but we can add it as part of our investment thesis. Now, insider trading, as always, buying and selling. I personally like to see insider buying. It is essentially a bullish signal. It shows that management are looking to buy shares for one reason only, which is because they believe the share price will increase in the future. Sales, now we can see the vice president has sold quite a number of shares, in fact around $1 million worth of shares in Verizon. It isn't necessarily a bearish signal, it is just something to point out. Lots of insiders tend to sell for a wide range of reasons. It could be personal reasons, it could be financial reasons, but just something to point out as well. I wouldn't copy what insiders do, especially when it comes to sales. So let's take a look at the dividend safety score. Now it's sitting at 70, so it is safe. Market cap 166 billion. It is a mega cap company. Now, in terms of those recessionary metrics, well, they increased the dividend during the last recession. They had above average growth, so negative 1% versus the S&P's negative 12, and they also outperformed the S&P negative 38 versus the S&P's negative 55. Dividend growth, it should come as no surprise. This isn't something that makes me happy. It is below the average inflation rate at 1.9%. We like to see a minimum here of 4% just to keep in line with inflation. And we can see even over the last 20 years, 3% on average, you would be losing some of that purchasing power with those dividend increases year on year. Just to note though, they have been increasing those dividends for the last 16 years. Now, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. We have a double sign of undervaluation, 6.38 versus 4.57, as well as the forward P, 9.3 versus 10.5. So we can see here that we do have a strong undervaluation signal. But do bear in mind, we're not looking at any of these models in isolation, and we will draw conclusions towards the end. Verizon is sitting at a 9.3 P versus the communication 16.7. Now, in terms of the free cash flow payout, now this is where the worries start to come. Typically, investors will look at earnings. They will be happy year on year below 70%. But remember, it is susceptible to manipulation by management through accounting. So I personally focus on free cash flow. For telecoms, around 70%. For other companies, typically 60%. What this shows to me, in 2022, Verizon paid out more in dividends than they generated in free cash flow. Red flag indicator there. On the plus side, it has come down in 2023, expected 81%, but that is still quite high, which does make me believe that that dividend increase in 2024 will be again below inflation. When we look at the free cash flow per share, well, it's doing the different, or going in the wrong direction than what you want to see. 8.29 in 2013, 2.48 in 2022, although it is expected to go higher in 2023. Still, there are a lot of inconsistencies here. Some years do look strong, some years you just don't know what you're going to get. We can see in there 2021 that negative free cash flow per share. Sales growth, again, as a minimum, what we're looking for here is steady moderate growth, 3 to 7%. What this means, if it doesn't get at least 3%, then as always, it isn't keeping up in line with inflation. So in real terms, the top line is decreasing. It went through a period, 2013, 2014, at least keeping up in line with inflation. Then we see the following 2 years, 0%, no growth, and in fact negative growth. And it's pretty much followed that trend year on year, as we can see. 2023 expected a drop. So again, just something to bear in mind. These are things that you need to understand before investing in companies. And over the longer term, 121 billion to 137, it's not even keeping up with that inflation of 3 to 4% year on year. Shares outstanding as well. What we'd love to see as investors when companies return excess cash to investor pockets. They've done the opposite. If you had bought shares in 2013, your position would be diluted as a shareholder, 2.87 billion to 4.2 in 2022. ROIC, I would like to say this is positive because I do look for 10% or more, as it does give me faith that management are able to effectively allocate their capital. But what we can see here is from 2015, it has pretty much come down 1 percentage point year on year. Now 2022 and 2023 at 10% is okay, but it is a bit of a worry. We are seeing this come down pretty consistently, so it is something I would definitely keep an eye on if I was an investor of Verizon. Operating margin, positive to see. It is consistently in the mid-20s year on year, 2022, 2023, more of the same. Free cash flow margin, a lot more inconsistent, but in better news, 2023 is expected to show around 10%. In terms of the net debt to EBITDA, now this is the earnings before interest, tax, depreciation, amortization. Tells us two things about a company, the balance sheet strength as well as the dividend safety. 3.37, so this is the number of years it would take them to pay off all of their debt net of cash on hand. 3.5 for telecoms is the maximum, so it is straddling around that maximum. 2023 expect to be slightly lower, so it is something I would keep an eye on. We did see how high that level of debt was, so a little bit of a worry, something just to bear in mind. Now let's jump into the valuation model, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, just before we do get into the valuation, we have just released our first free weekly newsletter dropping every Sunday. If you want to grab a copy, do click on the pinned comment below, completely free. We discuss our 7 golden dividend metrics when analysing undervalued stocks. Next Sunday's episode, we will cover a undervalued stock and do a deep dive. Jumping into the valuation then, let's get to Graham's valuation, the first model. We have the earnings per share, the long-term growth rate, and that yield on AAA corporate bond, giving intrinsic value of $36. Now with the market value at $42, we have our first sign of overvaluation, but as always, do bear in mind we don't look at any of these in isolation. Now, multiples valuation, the only real direct comparison I would use would be AT&T. Now, given the fact they have negative earnings per share on the trailing 12-month basis, we won't use this model for Verizon today. So we have the dividend discount model, we have the yearly dividends. Now, the average growth rate at 1.84%. Forward looking, I've gone pretty much in line, just slightly under. So we can see this gives a sign of undervaluation, although only around $1 worth per share. Then we get to the DCF model. We have the free cash flows year on year, the average growth rate. Forward looking, we've gone with analyst expectations, and including that discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We have an intrinsic value, as we can see here, above the market value, so another sign of undervaluation. Don't forget, if you do click on that pinned comment below, you can grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio and those on your watch list. Now, margin of safety, typically we start off with 10% if we believe it meets 3 criteria: wide moat, strong financial metrics, good forward-looking data. Now, if we use 10%, it would be a buy up to $37.50. Essentially, what we are saying is the intrinsic value is pretty much at the current trading price. So we see 0% of a margin of safety. And this being a telecoms company with a lot of risk, we have a lot of litigation issues that have been ongoing, as well as a potential dividend cut, given the fact they are taking on a lot of debt. Margin of safety for me would be very high. I personally would be looking around 30 to 35%. At around $27 to around $30 before even considering. So you can already know where my mind is at with Verizon. In terms of Wall Street and what they forecast, well, over the next 12 months, they have 0% upside. One of the few companies we have reviewed on the channel where we get an upside of nil. As always, though, their price forecast is $42. Just because Wall Street have a price forecast, it means absolutely nothing. And we just add it in as part of our valuation. As always, though, do let me know your thoughts. Is Verizon one that you are adding? Is it one you are selling? Or maybe you are even holding because you bought at a very low price towards the 52-week lows and your yield on cost is very high. As always, don't forget, smash that like button if you enjoyed today's episode, and do subscribe and hit the bell if you want to be continually notified of these videos. As always, have a great day, catch you on the next episode, and take care.